Good afternoon, everybody. My name is Marilyn, and I am a financial educator, and welcome to my channel, Financial Planning 101. We're delving into the Money Milestone series, and we're going to touch on milestone number 2, which is protection. Okay. So your income creates your wealth. And this is why the second of the 7 money milestone is the first being to boost your financial education, okay? And should be to protect your income. All right. So let's get started. All right. So proper protection. And this is an important reason. You need to protect yourself, your family from possible future loss of income or savings before you chart the rest of this journey. If you were to die prematurely, God forbid, your family could be left without your income in addition to being without you. So your current savings might not be enough to take care of them. All right. So this is a very important milestone. So through protecting yourself is more important than protecting your property, as Thomas Paine put it. You might not be able to fully protect yourself from illness or accident, but you can protect your income and your wealth. Ironically, protection of your financial asset is called life insurance. It's a defense strategy motivated by a sense of love, responsibility, or both. So, how much life insurance should you have? The answer is that it's different for everyone based on your situation. However, as a rule of thumb, we recommend you consider having life insurance cover that is at least 10 times your annual family income. So, for example, if you earn $50,000 a year, you should consider $500,000 in coverage. Okay. And add a conservative 5% rate of return. Interest on that lump sum could replace half of your income. And let's say if you was making $100,000 a year, you should think about consider $1 million in coverage. Okay. So having at least this coverage, it makes a difference for any type of expenses that comes up. All right. For more specific calculations of your for your family needs, ask your financial professional. Okay. So together we can consider factors like how old you are, how much debt you have, your health, your number of dependents, your role in your business, and your overall financial situation. So all of this is considered. All right. And many people, such as Diane here, didn't know 10 times your income was just a starting point for protecting your income. Sounds expensive, but you need to look closer into it before you can decide you can't do it. You may be pleasantly surprised. The same people who underestimate how much life insurance they need have a tendency to overestimate how much it will cost. Both assumptions can keep families from putting proper protection in place. Okay. As insured.com says, only 59% of Americans have life insurance, and about half of those are underinsured. You and your financial professional should cover your short-term and your long-term debts and other outstanding loans, your financial goals, your mortgage, your rent payments, how old your children and how much their education could cost. And just like with so many things, life insurance, with all the options out there, seems complex at first. But once you know a little, it becomes far simpler. So to start, it's important to understand that all life insurance usually falls into two basic categories, temporary and permanent. So let's look at term life insurance, which provides coverage for a specific period of time, like 10, 20, or 30 years. It's the most affordable life insurance available because it provides one core feature, a death benefit. The money paid to the beneficiary when the insurers die, and because it expires after the term. And with term insurance, it's possible to have financial protection for your family or business with a relatively small monthly payment. This can make it a fit for anyone with a limited budget during times of highest financial responsibilities, like raising your children, paying off things like your mortgage or your college, and running your business if you are a business owner. But what happens when the term on your insurance ends? There are two scenarios you can look at. Scenario one is that if you don't need coverage anymore, you can just simply let your policy end. No fuss, no issues, okay? But then if after your term, you still need coverage because you're still paying off your home or you're a single income couple. So you may be maybe you're supporting grown children or grandchildren, or you're still running your company. For these reasons and others, you might consider scenario two, keeping your term insurance. If you're in good health or your term policy have guaranteed insurability, you might be able to renew your old policy. Remember, if you want a completely new term policy, you have to qualify medically again. If you can't qualify, a new term policy might not be an option. If you do qualify, the new policy will cost more because of your age. The older you are, the more expensive your term life insurance will be. And this is what we call the financial X wave. In your younger years, represented in the blue on the left, you typically have more responsibilities and less accumulated wealth. In your later years, the yellow side, the plan is for your accumulated wealth to increase as your responsibilities hopefully decrease. Term insurance is typically most useful when your responsibilities are higher and wealth is lower. The left side. If these two factors flip later in life as planned, term insurance become less practical. Your financial professional can help you look at how the X wave could be applied to your situation. Now, let's look at permanent life insurance. Like term, it provides a death benefit to protect your family financially. However, permanent insurance is designed to be kept and protect you for your entire life, not just a limited period like term. So think of permanent life insurance as a lifelong strategy that can protect your family today and secure wealth in the future, and perhaps for your family after you're gone. And there are three important benefits of permanent life insurance. Number one is life insurance protection for your entire family. Two, with many permanent life policies, you can add long-term care as an optional rider. And then number three is your accumulated cash value, which can give you flexibility with premiums. This means if you ever can't pay your premiums for some reason, they can be paid out of your cash value. And other benefits that can be included with a permanent life insurance strategy can be advantage like absolutely no market rate, long-term care coverage, tax-free growth, tax-free income, and tax-free legacy. Avoiding taxes is extremely important to consider because it can directly, significantly impact how much money you can live on in retirement and the amount you leave your heirs. So let's talk about that cash value component of a permanent insurance is and why it can be so important. A portion of your monthly premium is set aside in an account that grows over the life of the policy. And the money in that account is your cash accumulation and can be used to fund future purchases. You see a few possibilities on the screen. So, in addition to at no market risk and tax-free growth, income and legacy, as we could just mention, life insurance cash value can also be credit proof, meaning creditors cannot come after it. When you look at them all together, the advantage of a cash value benefits are very powerful. So we saw that long-term care can be added to a permanent life insurance policy as a rider. So let's talk about the importance of long-term care insurance for a moment. You may not know this, but 70% of people age 65 and over will need some type of long-term care service and support at some point in their lifetime. So, in other words, statistically, you will likely need it. But here's the thing, only 8% of the people over the age of 55 have purchased long term care insurance coverage. That sounds like a possible problem and an expensive one waiting to happen. So, long term care insurance coverage help cover out of pocket expenses that can really add up. It can be used to pay for qualified services like nursing home care, home health care, assisted living care, and adult daycare. And you never know if or when you might need it. And if you do, the average long-term care need, if more than 1 year lasts 3.9 years. As you can see here, the average total cost can be a crippling expense if not covered by a policy. The cost without long-term care coverage could drain one or more of your savings assets you were counting on for the future. And there are a couple of long-term care options you should look at. So the first is a traditional standalone policy. Even if you don't have life insurance, you can go directly to an insurance company to purchase a standalone long-term care policy. Or you can opt to add a rider to your permanent life insurance policy. If it's available for your permanent life insurance policy, you can add long term care protection to the policy in the form of a rider for the extra cost. Everyone should look into this option. If you go with option one and buy a traditional standalone policy, there are a few things you should know, like the fact that premiums start low, but insurance companies can raise rates on them. Also, you also pay for care upfront out of your own pocket, then get reimbursed, which can be seen as an inconvenience during a difficult time. Another thing to keep in mind with the standalone option is that you could spend thousands on premiums and get nothing back in return. So, although there's a 70% chance you'll need long term care, there's also a 30% chance you won't need it. Or if you go with option two and you choose to add a long term care rider to a permanent life insurance policy, a key advantage of this option is that life insurance companies typically don't raise rates for life insurance policy holders. So some insurance companies, after a waiting period, pay you money to cover long-term care expenses, which you can spend however you see fit. No need to submit receipts once the eligibility requirements have been met. Coupling your life and long-term care protection can equal a big savings. If one of the lucky 30% who ends up not needing the long-term care, your premiums aren't wasted. Instead, your family receives a large tax-free death benefit. And long-term care riders aren't the only riders available. You can also consider other living benefits like critical and chronic illness riders that can help save the day if you face any of the health challenges like you see on the screen. So you should discuss adding these riders on your permanent life insurance policy with a professional. Some are inexpensive or even cost nothing extra to add on. And our mission is to teach 20 million families how money works within the next decade. And we're going to stamp out financial illiteracy in every community. And that's a huge undertaking and one that will require any army of thousands of financial educators. We are looking for people to help us teach these classes. And this is where you and somebody you know can come in. All right. So thank you for being here with me. This is the end of my video. And my name is Marilyn. I'm a financial educator. All my information is in the description box in this video. Go onto my website, download the free ebook. I have a multitude of resources at your disposal, which I have workshops. I have a financial literacy quiz that you could take. And also I have ebooks that you could download for free. All right. And hey, give me your comments. Feel free to give me your comments in the comment box. Give me some ideas, what you want to know. If you have any questions, please send it to me in this email in this video and let me know what is your feedback on this video, okay? And again, my name is Marilyn. I'm a financial educator. Welcome to my channel, Financial Planning 101. And I will see you in the next video. Bye-bye.